One of the issues that has been created by all of the easy money and low interest rates is overvaluation in all asset categories.
In the background for this is, as you say, bewildering. People who've been trying to set themselves out of harm's way and by moving cash, for example, into savings accounts or checking accounts, just going to dollars and holding them in the bank. Well, first of all, there's a whole problem we've talked about several times in the past about how, in a very real and meaningful sense, nothing in the bank is yours. But aside from that, the dollar balances that people may be putting into checking and savings accounts, and my wife and I were among them, have been just hammered in terms of any kind of return. There was like money market 2% rate, and then it went down to 1%. Now it's at 0.01% rate. But that's not the worst of it. The worst of it is what you talked about. And as we mentioned with John Williams from shadowstats.com, joining us and saying if the CPI is admitting high single digits, 8-9% consumer price inflation, that the actual rate is multiples of that. So your actual purchasing power of the dollars that are sitting in the bank, which are eroding away at 10% or more per year, that you're falling behind. So I'm having more and more clients who reach out to me saying, look, I just sold a house, or I just sold a property, or I just came into an inheritance, or I just rolled over from a retirement plan, and I am not comfortable just having those dollars sitting in the bank because I know I'm losing out. That's in the face of that. That's again, first there was the low interest rate that you're getting paid. Then there's the second, which is the devaluation of the currency through overprinting and so on. And that's also distressing that on the nightly news, as they're talking about high gas prices and everything. Oh, by the way, multiple stories out in the last day saying that both food and fuel and electricity may all double yet this year for people. So, and the big picture of access and stability of savings in the bank goes beyond just the inflation rate, because as Gregory Manarino has been warning us, he says you've got to watch the debt market. When the debt market becomes unstable, things can break very badly in a very big way and lock up the credit markets and access to funds and that sort of thing. He just tweeted this morning on his newsletter, the debt market has become unstable. Watch out. So in the face of instability in the debt market, risking in the banking system, devaluation of the currency, ordinary people are really trying to figure out what should they do to protect themselves from this runaway inflation, which sounds like it's not going to go down anytime soon. Any specific strategies that you've been looking at that people should pay attention to?
It's very difficult. I mean, there are very few places left to turn because one of the issues that has been created by all of the easy money and low interest rates is overvaluation in all asset categories. And so where to put your money is difficult. It used to be, people would feel great having money in the bank, but as you mentioned, in the face of bail-ins, in the face of gaining the money markets, in the face of nothing in the way of return, when you look at losing double-digit purchasing power each year, leaving it in the bank is not an option. Putting it into assets that are massively overvalued and have been for 2 years that will crumble in the face of rising rates is not a good option. And so this is a problem that I think people need to understand. And this is why I say he who or she who loses least wins. In this environment, the best thing to do is, first of all, realize that profit is not a four-letter word. If you're sitting in equities right now at profit, it's time to take some profit and redeploy it. Where do you redeploy it? Look, I keep coming back to the fact that I sell precious metals and I'm trying to be objective. I'd like someone else to tell me where there's any value. Look at gold and silver in comparison to all of the other asset classes, which are many times their all-time highs in most cases. And gold and silver, half of its all-time high, and gold, still a few $100 away from it. There's still value to be found. They are muting the canary in the mine shaft. They don't want gold and silver to express themselves as things are breaking apart. And I think as it becomes more and more obvious that the Fed is out of options, if the Fed really does come back in and start to, reaccommodate, to to come back in and add liquidity into the market, to lower interest rates again, I think the likelihood of them losing all credibility and inciting a major currency collapse is real. I don't want to take a step back for a moment, because I think a lot of people focus too much on the Fed and the Fed's ability to engineer this tightrope, to walk this tightrope of inflation and asset prices and interest rates. You know, we've talked a lot about the Belt Road Initiative, connecting 75% of human population. It just announced that Iran and India and Russia have struck a new trade route, a conduit for trade between Russia, India, and Iran. You are seeing 85% of the world between the BRICS nations move away from the dollar, settlement away from the dollar. We've talked about the problems that we are facing with retaining or maintaining and keeping our petrodollar status. All of these contracts, all of this trade, it is all going through other parts of the world, through the Belt Road Initiative, and now this long conduit between India and Iran, with free passage all the way through, safe passage all the way through. And all of these contracts are settling outside the dollar. As less and less demand is found for the dollar, that will in and of itself push interest rates higher. The Fed does not want to be to blame for blowing everything up. So the villain will be OPEC. It will be the BRICS nations. It'll be the countries that move away from the dollar. We've talked about the weaponizing of the dollar. We've talked about all of that. So what I'm simply saying is that not only do you have to worry about the Fed engineering a tightrope, I think you have to worry about the rest of the world looking for alternatives to the dollar and building infrastructure to do just that. And it's one of these deals where we're going to wake up one day to a new reality where the dollar, which, you know, for the last 50 years has had to be accumulated and owned by every single country on the planet in order to purchase oil, those days are coming to an end. And all of those dollars out there, remember, we only represent roughly 10% of the population of the world here in the United States. You got 90% of the world who has to own dollars to buy oil until that stops. And when that stops, if you think inflation is bad now, if you think rising interest rates hurting equities and real estate values and bond portfolios are bad now, wait until you start to see a global divestiture of dollars, not just by the insiders who have been accumulating gold. You know, we had talked a lot about during the reclassification of gold, but the countries that repatriated their gold, they were all these Eastern European countries that weren't part of the euro. And it kind of dawned on me the other day in looking at it, when you see the numbers that are coming out of the countries that are not part of the euro but are in Europe, they are massively accumulating gold. You have like Poland, like the Czech Republic, like Hungary. These are the countries that repatriated their gold and went on a gold buying spree in 2017 before it was announced that gold was being reclassified Tier 1. And this year, they're adding 10 times the amount of gold. Each one of these countries is buying over 10 times the amount of gold they did last year. You have the repositioning by all of these countries, whether it be in accumulating gold, which means selling dollars, or building trade routes that aren't part of the dollar, striking deals that usurp the dollar. This is where the catalyst comes in. And so I think people need to understand that, yes, it's been a hell of a ride that the Fed has engineered for the last several decades. But you want to stay out of harm's way right now, you need to take some profit. You need to redeploy it. You have to have some metals. And I don't really know anywhere else to safely put it. And I'm telling you, I think about this all day long, because the low interest rates have blown up asset prices so that there are no affordable alternatives that will protect you in this event. Look to silver, look to gold, look to platinum. Those would be the three places, maybe even in that order, that will give you some form of refuge. And again, it's not about getting wealthy. It's just about not getting crushed when either the Fed blows things up or, in my opinion, equally as possible, you start to see such a massive move away from the dollar by these BRICS nations, and a continuing increase in gold accumulation, that we wake up to a new reality at some point very soon. As I've said, I believe it will be a BRICS nations currency backed by gold, not convertible, but backed by it with the veracity of it, the immutability of it, denoted on a distributed ledger. And there is no coincidence that the Chinese have already done close to 10 billion in transactions on the Belt Road Initiative on their new digital yuan. It is that technology that I believe the BRICS nations will launch a gold-backed currency. And all of these countries that keep accumulating gold, they're going to be part of it. And the West will be left isolated out in the cold. That is what I think is a bigger threat, or an equal threat, to the quandary that Jerome Powell and the Federal Reserve find themselves facing.